Awesome. Hello everyone. Thank you so much for joining us for the webinar today. As a company, we hold these webinars to help all of our volunteer board members to get a better grasp of important topics regarding to the HOA. Our topics include law, insurance, reserve study. We just invite all of these experts in the industry that can create value and kind of knowledge to the board and to the community. So today, I'm very excited to introduce one of our great friends, Luke Prendiville. He's a broker at Prendiville Insurance Agency. Luke is one of our go-to experts. He works with, different communities, just like our small HOAs or big HOAs every day. So he really understands what the boards are up to against in this market. And just like a quick disclosure before we kind of jump into uh, this webinar, please keep your questions general, rather than community specific. So if you have questions about your particular association, please feel free to reach out to Luke or to us or your management company. Thank you. So it's all yours, Luke.
Perfect. Well, thank you, Simon, and thanks to the HOA Simplified team for inviting me on. As you said, my name is Luke Prendiville. I have been in the HOA industry for a number of years now, with insurance background at the insurance carrier side as well. And Prendiville Insurance, just a little bit of a background with us. We primarily work with HOAs to insure them. We've been doing it for 37, so getting close to 40 years, not myself personally, but the agency itself. And we've been doing it all throughout California, and we have a presence in other states as well. But when they came to me to talk about this topic, I was eager to go in depth about it just because I know that the rising insurance costs is a very important topic to a lot of board members and a lot of communities. Inflation has not been kind to us, and we're trying to see what we can do to wade through that process. So I kind of figured we would talk about, just generally speaking, what's happening within the insurance industry, and then kind of start to focus in on, well, what's one of the things driving up all these rate increases? Most typically, it's claims. So we're going to go into kind of the claims process and also how directors and officers claims affect boards as well. Okay, so the largest factor to, or kind of thing underpinning this whole insurance crisis right now is actually reinsurance. And if I can just kind of explain a little bit about what reinsurance is that basically these insurance companies, they try and take on as accounts, they try and take on risk, and they say, hey, we can insure this association, for example, for X amount in premium. Typically, if these have too much total insured value within the community, too much to replace in building value, for example, then these insurance companies might not be able to take it on as much as they'd like to. So they go out to buy reinsurance. And this goes back to the early days of insurance, back with Lloyd's of London, which is a big insurance syndicate that you may have heard of before. But they would literally take these ships that are going to the free world, and you would have these investors, they were called investors at that point, putting money on these ships, saying, we'll put on X amount that it gets back, that we get our cargo back from the free world. This kind of underpins the entire insurance market for a long time. And it's been a really helpful process, actually, for a long time. But something to remember is that this is a global market, whereas insurance is more handled on the local level, typically speaking. So, for example, every state has their own Department of Insurance, whereas the reinsurance market is a global market. So, what I always say is the earthquake in Lima, the hurricane in Florida, the whatever, anywhere in the world is going to affect the reinsurance market as a whole. And what you really saw to really ramp up the reinsurance market, especially locally here in California, is, well, the elephant in the room are the wildfires. So, I mean, this has been a long-standing issue since well before the LA wildfires. But I would say in earnest, this whole reinsurance crisis kicked off in about 2018, 2019 with the fires up in Santa Rosa. Another good way to think about reinsurance, by the way, and how it is more practically used is during the Santa Rosa fires. there would be insurance companies. Let's say they got $1 billion in claims, for example, billion with a B. And the insurance company could say, well, we paid out only 250 million of those, so a quarter of it. How does that work? It's not them not paying the claims. It's because they have reinsurance. So they pay up, their reinsurance treaty would have said, we paid up to the first 250 million in the claims. And then after that, the reinsurance partners take over and pay out the claim. So that's kind of how that works, generally speaking. And that kind of shows why these reinsurance markets are feeling a lot of pressure, and they tell the insurance companies to kind of tighten up their belts when it comes to their underwriting procedures. And then that kind of goes into this slide actually pretty well because there's been a lot of movement within the insurance industry as far as what these insurance companies are doing. For example, the PUD appetite has shrank. When you think of a PUD, think of single family homes, so not like a condominium or townhomes or anything like that. Large associations, they're growing out of favor. It's just way too much property and way too much exposure in one location for these insurance companies to take on. There's only a few that really do these large scale associations. A lot of them started to reel back a little bit. Umbrella policies have reduced appetite as well. Long gone are the days where it was easy to get just absurdly high umbrella limits. Typically speaking, you see them really starting to come down now. Oddly enough, earthquake premiums are starting to stabilize. I wish we could tell you why. We get different answers when we ask different people, but the moral of the story is that the earthquake premiums are starting to stabilize, which is a good, welcome sign in our books. And then older properties are coming out of favor as well. So typically in the admitted market, we see that as old as 50 years old and sometimes as new as 30. So it can be as restrictive as that or as new as 50. And then some other actions were that there's been some insurance company moratoriums. And what that essentially means is certain companies are kind of entering and leaving the market, for example, or reducing appetite. Uh, like, for example, State Farm is really pulling back, and that's actually one of those other points in about 2 points there. State Farm was downgraded to a B on AM Best. And when you think of AM Best ratings and financial ratings, a B isn't like in school where a B was kind of okay if you got that as a grade on your report card. A B in the financial setting is really shaky, and it becomes harder to get for loans to be paid out in that community. For example, it's going to be harder to get claims for the unit owners. Rate increases have been happening as well. That is across the board. I'm sure you've seen that within your own communities as well. And also just increasing premiums comes with that. And then there's going to be a lot more scrutiny on claims, which is why we brought up the whole claim situation within this whole second half of the presentation. Something else, and I kind of alluded to this with the whole wildfire situation. There's a big focus on all these fire maps going on within the industry. This is an example of a fire map that a lot of companies use. It's the industry standard one. This is, it's technically public information, although you need a subscription to it. Some companies have their own proprietary maps, though. And so, for example, like Farmers Insurance, for example, we can tell them, hey, look up this address, and they will tell us if it's eligible or not. I've never seen what their map looks like, though. Some companies, they use CoreLogic, which, this is an example of that. And then this association, right on this pin right here, that one would be very hard to get coverage for because it's in that orange space. A lot of companies, they don't want to look outside that whole green area because the further we get to that, the more likely there is that a wildfire comes through the area. Something that's very important to think about when we're talking about insurance is the standard market versus the excess and surplus market. And really the most important thing for the sake of our discussion and the thing that most people probably care about is what I have highlighted in red. The difference between these two markets. And I want you to look at both sides of this line that's in the middle there. Think of these as two different columns, right? So this left side is the standard market, and then the right side is the non-standard, also called non-admitted, also called excess and surplus side. In order for a company to be considered admitted and do business within the state of California, they are subject to the Department of Insurance approval. So they go in and say, hey, for this product class in this sort of area, this year build, we want to say that we're going to charge within a range of this rate to this rate. And the Department of Insurance and the Consumer Watchdog has the ability to say yes or no. The non-admitted companies don't need to do that. And because of that, your premiums typically are a lot higher when you're on the non-admitted side. Now, there's a reason to have this non-admitted side, and it's typically for if there's a non-standard type of risk. I think the most extreme example is, some factory developing some crazy products, just very, very high risk. Whereas something that's, pretty safe is, an HOA with no claims, right? Or let's take it to the HOA example, actually. Typically speaking, you might have something like an association that's in a high wildfire zone, or it's a very old build, or it's been having a lot of claims issues. That's what you're typically going to see on this non-standard side. Whereas, newer builds, not within risk of wildfires, not a lot of claims, that's going to be on this left-hand column in the admitted side or standard side. And then these electrical panels, this is something that we talk about every single day in our office, and I'm sure every other insurance agency talks about this in their office every day as well. This has been a real thorn in the side of the industry. And just as a little bit of a heads up, in case you haven't heard about it at this point, there are a couple of brands of electrical panels. I say a couple, it's quite a few, and sometimes it's easier to say what typically is seen as safe versus what's not, just because we're not the experts when it comes to brands of electrical panels and how they operate. Obviously, we just know what the insurance company's telling us. But essentially, there are some brands of electrical panels where if they are from specifically within, like, let's say the 1960s and 1980s, somewhere in that range, there's a higher likelihood of these panels being dangerous and causing fires, and it essentially becomes radioactive for insurance companies to be on. They'll throw their hands up and say, hey, we're getting off this account. So if your association is seen to have these electrical panels, my advice would be get rid of them as soon as possible. Not only can it affect your insurance, but there is also the life safety concern as well. And I have some examples of some panels that are kind of hot button issues. The most notorious, the big dog of them all, is Zinsco. We almost use Zinsco as an example of is sort of like a synonym of these defective panels. Zinsco is one of the most popular ones. There is also Federal Pacific. They're also called Stablock. And then some other popular panels that kind of show these issues are Sylvania, GTE, Challenger, and Pushmatic. If you know that your association has these panels, I'd say talk to your broker about trying to get them removed. It is it can be a costly project, but at the same time, not only is it safer to get rid of them, but then your insurance premiums are more likely to go down as a result of you taking them out. So with that, we're going to transfer over to the claims process because, as I mentioned, that's kind of the biggest driving factor within what's happening with a bunch of rates. Obviously, the wildfires and being in high wildfire areas can affect it, but in reality, the thing that always stays a constant are claims. So whenever a claim arises, I think the best thing that you should probably do is, first of all, look at your unit owner letter. This is an example of one. It's a little outdated for us, but this is one that we used to send out. We do send out a unit owner letter still, but essentially these unit owner letters, they just kind of say, what's covered within your policy. And this is a good way to kind of tell, hey, is there going to be a claim that happens and are we covered for it? It also goes into things like your deductible, how you file a claim, all that great information. So it's always a nice little value added when you work with certain agencies for sure. And then when we're talking about claims, and by the way, this is specifically talking about a property claim. We're not talking about general liability right now, which is a very important distinction because they are different and they operate differently as far as how the claim is handled. And before I go into that, actually, I might as well just dive into that a little bit more. Think of your insurance policy as almost like a coin. You have one side, heads and tails. It's on the same coin, but they're radically different. They're radically different concepts. So we're talking about specifically property right here. When you're talking about a property claim, the adjuster is really going to ask only three different questions. Is it a covered cause of loss? So, for example, is it a fire? Fire is almost always going to be covered. Is it a water loss? Well, it depends what happened with the water loss. Was it a sudden and accidental discharge of a pipe or appliance? That's going to be more likely to be covered than a slow ongoing leak. That's one of those water losses that typically is not going to be covered. The next question is, are the damaged items covered by the policy? So let's take a condo, for example, a condominium association. And let's say there was some sort of claim and the drywall was damaged. The drywall in the HOA policy is always going to be covered, most likely. But for example, some personal property, or maybe let's say we're talking about a bare walls policy, maybe some upgraded nice cabinetry, for example, that wouldn't be covered in that situation because that's not what the association policy from those CC&Rs is covering. So you got to figure out, are the damaged items covered by the policy? And then the third one is the total amount of damage in excess of the deductible. So basically, is your deductible higher or lower than the claim? If it's falling underneath that deductible, then it's not technically a covered claim in that situation. And the insurance company is not going to ask who's or what does the maintenance matrix read? That is a very common question when you talk about claims. You might have someone say, "Well, hold on, our CC&R say that this is the unit owner's responsibility, not the association." The problem is that they're typically reading from the maintenance obligations within your CC&Rs, not the insurance section. There's an entire insurance section within your CC&Rs that tells you up to where the insurance policy is going to be covering. So it's a very important thing to consider when we're talking about a claim. The other thing, and again, we're talking about property right now. The other thing the insurance company is not going to ask is, whose fault is this? The important thing to remember in that situation is we're talking about a property claim, which is a first party situation. We're not talking about a liability where it only matters whose fault it is. The only thing they're going to be asking are those three questions. Is it a covered cause of loss? Is the item damaged, covered by the policy? Is it above or below the deductible?
Yep. Luke, I think before we kind of get into nitty-gritty of kind of filing insurance claim, I think
Yeah.
it would be helpful for our board members to know like what are some common mistakes that you see in terms of uh, insurance claim filing from just your experience.
Yeah, well, and there's actually something that we're going to be going into a little bit more in depth later on in the presentation. But what I would say is one of the biggest things is sometimes they just don't file the claim, right? And so let's talk about a property claim, for example. A property claim, as I said, is a first party claim. It's not about whose fault it is. It's just, hey, we need money. Something bad happened. It's what insurance is for. Um, it's for making you whole. But maybe the association thinks, hey, we don't want to affect our policy, we don't want to affect our premium, so we're just going to handle this internally. We're not going to do anything on it. And this situation just kind of keeps unraveling, unraveling, unraveling. And now you open yourself up to litigation and a GL claim at that point. So what started off as just a property claim eventually devolves into this nasty liability claim where there's lawyers involved and just want to avoid it. So that's probably one of the biggest mistakes that we see when it comes to filing a claim, and it's not filing a claim. And something else I'll touch on is the association policy is considered a commercial lines policy, not a personal lines policy. Um, the strip mall down the street is in the eyes of the insurance carriers no different than an HOA at that point. It is a commercial risk. You have a board of directors, and so it's important to know on commercial lines, you're not penalized for only opening a claim. You can always withdraw.
Makes sense. Awesome.
Yeah, thank you. All right, so the important beginning steps before you even file the claim. So let's say, the claim just happened. Mitigate the damage. So for example, let's say there was a sudden accidental discharge of a pipe or appliance, shut off the water. I'm sure that's everyone's going to do that, but it's always good to say it. And then heavily consider notifying the HOA insurance company and the unit owner's insurance company. Kind of like what I said, letting them know, hey, something's happening. is always going to be better than sitting on it and not doing anything about it. And unfortunately, sometimes it makes it almost worse at that point. So important claims considerations, type of coverage, some helpful questions to kind of think about with this would be, what does our policy cover? For kind of going back to the example of, is there a drywall that's been damaged? That's probably going to be covered by your condo association policy. But the nice sofa, that's not going to be covered. Deductible size, is this above or below your deductible? Again, that's always going to be a big, big issue. Okay. Uh, this is kind of what I was talking about with Simon's question. When I was talking about you should always be filing a claim when it comes to commercial lines, when in doubt. If a benefit is possible, file a claim because the claim can always be withdrawn, and a claim with zero payout does no harm to your policy. I'll give you actually a personal example from my own life. I know someone, without saying who it is. They had some sort of situation with their own personal home. It was a single family home, but the concept applies. Um, where they thought they were going to have to use insurance, so they file a claim with their insurance carrier, and it turns out that the insurance carrier doesn't pay out anything in the claim. Since this is a personal lines policy, that ended up dinging his insurance for next year, and the rate went up a little bit, and his premium went up a little bit. That's a personal lines policy. But right now we're talking about the homeowners association. So a commercial lines policy, that would not happen when it comes to an HOA policy because once again, as I said, a claim can always be withdrawn without any harm. So even to the point where the adjuster has done his full review, said how much needs to be paid, right up until he cuts that check, you can withdraw that claim and you will not be penalized. So that's a very, very important thing to consider. Okay. So a very popular question that we always get, and it would have been fun to make this a little Q&A, but it looks like the technology glitched a little bit. But the question typically is, does the unit owner have the ability to file a claim? A lot of boards and a lot of managers sometimes think that no, that no, they do not have their responsibility to claim because the HOA board is there to be the custodian of the policy, is to help maintain the policy. But here's the issue, is that that unit owner is technically part of the policy. So yes, they have every right to file a claim. However, something that is always good to know is that the board could decide to withdraw the claim. It's all very circumstantial in that point. But something that's always important to be careful of is, you don't want to deny a benefit to someone that's owed. So that's always going to be a really important thing, or else, a future lawsuit might come up. That's an example of a property claim unraveling into a liability claim. And then here's another one that's always been a very popular question, and something. This is a good context for this is typically speaking, these personal line policies and these commercial policies are supposed to work hand in hand. Where the association policy leaves off is where the personalized policy is supposed to start up again. And so the question is, which policy is primary, the master or the unit owners? And almost always, it's going to be the association policy is primary and the unit owner is secondary. And that's for if, for example, there's maybe like overlapping coverages, for example. Another practical way to think about this is the fact that association policy deductibles can sometimes be pretty high because this is sort of where that plays into. Let's say a claim doesn't meet that deductible threshold, then it goes on to the unit owner at that point. And the unit owner can use their personal lines policy to help pay out that deductible and help pay out the claim. So the most important person throughout this claims process is going to be your adjuster. Your insurance agent is not the adjuster. Our claims representative is not the adjuster. The adjuster is from the insurance company who writes the policy. And they're there to determine what causes of losses are being triggered, what's being damaged, how much it's all worth. Everything that's going to happen throughout the claims process is going to be essentially quarterbacked through this adjuster, and they're going to be responsible for coordinating with the insurance company and the board and everyone who's going to be involved with this claim. And at the end, they're going to provide the clear estimate and distribute the funds of how much is owed. And when this adjuster is working on the account, they're going to take this sheet. This is an example of one. It might be a little outdated, but it essentially gives you the idea of the building loss worksheet. And essentially, they go into, okay, well, here are all the components that were damaged. Here's how much it costs to replace it. And then at the end, you total it up. And then after that, you less out the deductible, and then you eventually get your net claim. Okay, and so then this slide is sort of meant to be from the standpoint of a conversation between our agency and an adjuster. If we ask the adjuster, what kind of problems they hear out in the field as far as, what goes wrong during these claim scenarios, or what any confusions that come up, what they would say most likely is one of the biggest stumbling blocks is this concept of unit owner responsibility, and it kind of goes back to that whole maintenance matrix. Sometimes people might think that that this is something that the association policy should not cover because the maintenance matrix says one thing, but in reality, the insurance requirements say another thing, and it eventually kind of starts unraveling again and again and again. And typically, when this happens, it delays the claims process, which kind of gets the claim out of the insurance company's control, and this results in spiraling costs. A very big misnomer is that insurance companies like to draw out their claims process. I can tell you that they actually want to get it off their desk as soon as possible because this is how they, lose track of everything, especially these property adjusters. They're actually supposed to be getting these off their desk very quick. If you ask any claims adjuster, they'll tell you they are, one of their metrics is how quick did you handle this claim to get it off your desk. So that's always good to know. And then as far as the claims process, kind of going into deductibles, it's always kind of good to know exactly what a deductible is, and it's the amount of money withheld from a property claim. So, for example, you have a claim, it's a fire claim, and it's a $50,000 claim, but your deductible is $10,000. The insurance company is going to give you a check for $40,000. So it's essentially how much is going to be paid from the association at that point. And there's always a big question when it comes to HOAs, who's responsible for paying the deductible, the HOA or the unit owner. There's oftentimes we see that CC&Rs require the unit owner to pay the deductible, which can be done through their HO6 policy.
Luke, I might be jumping the gun here a little bit, but
Mhm.
I've seen cases where kind of board members, because obviously of the insurance crisis issue, and the premiums are rising, I think board members kind of shifting towards, oh, just how about we just have, you know, a bigger deductible, right?
Mhm.
Or just somehow trying to navigate through ways to find a insurance that that allows them to pay less premium. So what are your thoughts on this regarding kind of this issue that we see so far?
Yeah, well, I have two thoughts about it. Number one, it's definitely a very handy way to mitigate claims, right? So, if your deductible is too low, I mean, if your deductible is too high, for example, not too high, you never want it to be unusable, but let's say you have a high deductible and you've been having a lot of water issues, for example, within your community, a lot of water claims, and you raise your water deductible, and then those claims start falling underneath that deductible, so the association policy can't pay out on it. That's naturally going to help out your loss runs over the next couple of years and hopefully get your claim situation under control as you're doing preventative maintenance to make sure that this whole situation is not going to be an issue anymore. Something else that's important to know is, as a little side tangent, is preventative maintenance goes a long way with the insurance company, showing them that you're doing everything you can to make sure that your association is staying safe, not damaging, all that stuff. Accidents happen, but they're gonna look on it a lot more kindly if you had one water loss over the last 20 years, for example. They'll never look back that far, but one water loss over the last 20 years versus five or six every year, that's a night and day situation for them. So that's always a good thing to keep in mind. The second thought I have on deductibles is, as far as a tool for saving money, it's definitely true. A higher deductible typically means a lower premium, but eventually, as your deductible raises, you start to have diminishing returns. So, for example, the difference of savings between a $5,000 deductible and a $10,000 deductible, and a 50,000 to 100,000, those differences are night and day. You're going to have a lot bigger savings from a 5 to a 10 than a 50 to a 100. Does that make sense? Okay, perfect. Yeah,
Yeah,
it's
it
a great
does. Thank you,
question.
Luke.
Yeah. Um, And so that's kind of the claims process as a whole. And since we have a lot of board members on the line, I thought it would be helpful to talk specifically about a coverage that applies to you all on the board, and that's directors and officers liability. It's the community manager and board member's best friend. I swear it is. And it is almost ubiquitous within the HOA industry. It's something that you almost have to offer because it's so valuable and important. And so what is it? Basically what this slide is saying is that it's not going to be a general liability or property coverage. It is liability that arises from within the boardroom. Within a board meeting, if some sort of claim is to arise from accusations of wrongful acts against someone from the board. So that's the really important phrase is a wrongful act. So what is it not? Again, it's not general liability. It's not property, right? So it's not going to. So a general liability claim, for example, is going to cover any property damage from the liability standpoint or bodily injury, right? So think trip and fall for general liability, and then think boardroom decision for D&O. So an important note, by the way, as we're getting into it, is that D&O policies change between carriers. There's going to be overall, it's going to be mostly the same policy form. However, there will be little differences between different insurance companies. So it's always good to consult with your insurance agent as far as what your policy looks like. And if you have specific questions about your D&O policy, it's always best to ask your agent because they're going to have a better finger on the pulse of, what does our policy look like in this scenario? Okay. Well, who's covered under a D&O policy? And it's a very, very topical question. Well, it's going to be any committee members, any board members, any past board members, spouse of a board member, management company or the manager, and the entity or the HOA, right? So the unit owner, for example, just the average unit owner isn't necessarily going to be covered under this D&O policy, whereas the board member is, right? This is an executive line. It's a management liability. Okay, most common types of claims. So these D&O claims can all kind of be boiled down to a couple of different scenarios. And the first one would be failure to adhere to your bylaws, so that's your CC&Rs. Let's say you're not playing by your own rules, right? You do something that breaks the CC&Rs, someone feels wronged by it, and they end up deciding to sue the association or the board for it. It's going to be the board's failure to provide a proper count of votes. So, we're actually going to have an example of this later on in the slides because we have some real life claim examples. But, for example, let's say you have a vote and you didn't actually go through the proper processes. That can open you up to a D&O claim as well, or the failure to maintain the common area, right? You guys are as a board, you were the steward of the association essentially. And, let's say everything's getting wrong down and someone says, hey, I just, I feel wronged by that. We have this board for a reason, and they end up suing. Some other common types of claims or challenges to any assessments, any easements, or any decisions from the architectural committee, or even powers granted to the board by the bylaws, right? If anyone feels that it's the board's kind of getting out of line on any of these, they have every right to file the D&O claim or to sue, and then that triggers a D&O claim. I mean, the most common types of claims also could be the improper removal of any board members, any breach of fiduciary duty, or any breach of contract, defamation by the board of a board member, any discrimination, or employment-related issues as well. So there's a lot that can go into a D&O policy, but it really all boils down to that one phrase. Any perceived wrongful act could open you up to a D&O claim. And then something else that's important to talk about is what actually constitutes a D&O claim. And it can be any written demand for monetary damages or non-monetary relief. Something that's important to consider is what is a written demand. It doesn't have to be kind of like this little picture. It doesn't have to be a pen on parchment. It can be an email, for example. Um, is it a text message? That's a very topical thing right now. It's a little unclear right now as far as if a text message could be considered a written demand. The insurance industry is notoriously slow moving, and I'm surprised that we're not using fax machines and mail still at this point. It's that slow of a moving industry. So it's a little unclear as of now, but I'm sure that's something that would develop in the future. Um, but something important to consider: verbal threats, they're not typically going to constitute a claim for directors and officers insurance. So really focus on those written demands. So if someone sent in an angry email to the board, that's something that could end up becoming a D&O claim if it's any of those perceived wrongful acts. Which kind of leads into this next slide. Should we file the claim? With D&O especially, if you ever have the question, should we file a claim? The answer is most likely yes, please file the claim. Now, this is because the D&O policy kind of operates differently from other insurance policies. It's a different type of form. And one of the most common reasons for these claims to be denied is not filing your claim in time. If you're filing your claim too late on D&O, there's a very, very high chance that it's going to get denied at that point. So the sooner the better. As soon as you hear anything, have your agent file the claim. And the same kind of principles apply when I was talking about claims earlier. If it ends up being nothing, you're not going to get dinged for it. So it's always a very important thing to consider.
Yep. Look, I think it'd be really helpful to the board if you could kind of give like an example. So for example, let's say there's an HOA and one of the home members are suing the board because of assessments. Let's just say maybe they done special assessments wrong or they didn't send out a notice in time or whatnot. So what is like the first step that they should do as a board member to trigger to file a claim?
Well, I would send the proof of it to your insurance agent, right? Always loop them in from the beginning of it, and they'll be able to kind of help direct you. What happens is you talk to your board, you talk to your insurance agent about it, and kind of get all the facts of the situation, and they will alert your insurance company, and then typically speaking, when these written demands come in, you're not already at lawsuit stage. It's something's kind of going down, but you don't know quite what it is. But the insurance company is essentially getting ready for any potential litigation defense, for example. So that's kind of the best thing to do. It's the idea of quote unquote putting the carrier on notice really mainly applies to D&O situations. Putting the carrier on notice with general liability and property, it's more so you're kind of just letting the insurance agent know what's going on and keeping them in the loop in case something goes down. But that's really, really important for a D&O claim. So that's kind of how that would initially shake out.
Got it.
Okay.
Yeah.
So the where and why the boards go in the wrong direction and delaying the proper notification of claims. Uh, there's this belief that the matter is not really a big deal. You have some sort of plan to handle it internally, or you have the fear of a rate increase. The important thing to realize is these are all not, these are all incorrect. You should not ever fall into these traps. If you have something coming up and it's written down, send it into your insurance agent, have them file a claim and put the carrier on notice because again, it will not hurt you. Okay. And these last couple slides we have here, I can try and be quick on them for the sake of time. But I have a couple of real life claim situations that we had seen. We changed the name of the associations. These are just generic names that we came up with. Usually use a lot of alliteration. But this first one, Whispering Winds HOA, you have this situation where a unit owner came to the board meeting, as is their right. Unit owners are always allowed to come to these board meetings, and she decides to bring her dog. Let's say it's a little Yorkie Terrier, and she brings it into the boardroom, and the dog starts barking a lot. It's just really running its mouth. It's barking a lot, and the board decides to kick them out of the board meeting, and because they have the dog with them, and say, hey, if you're gonna have the dog, you can't be here. The unit owner eventually, they feel they've been wronged and they sue the HOA under the ADA, claiming that the dog was a service dog. Lo and behold, they didn't know that. They didn't know it was a service dog, but the unit owner felt wronged, and this led to a payment of $7,975 on their D&O policy. So what seemed like just the board saying, yeah, this is causing a distraction, get the dog out of here, ended up becoming a $7,000 claim on their D&O policy. Okay, this next one, so Grumpy Hills HOA. Let me just kind of paint a picture for you as far as what happened. So the HOA decides to have an HOA attorney represent them, right? So they sign on their attorney, and within that contract, the attorney has them sign a contract that says he must be indemnified in the event that a claim arises from him representing the association. So that's the basis here. And now there's a unit that needs to be foreclosed, and he goes through the process with them, getting the foreclosure going, and he does something improperly, and he ends up getting sued by that unit owner. So then he goes back to the association and says, "Hey guys, I'm getting sued here. You have to indemnify me." And he points out that in that contract they had signed, that the association is now obligated to indemnify this HOA attorney. So from this contract that should never have been signed, the association ended up having to pay out on their insurance policy $32,000. So pretty large claim, that situation. And then the next one that I have here is the swimming hole HOA. This one is all about swimming pools. So let me paint another picture for you. So this is a larger association, and there were 7 swimming pools in this association. And they ended up deciding one day, hey, you know what, 7 pools, that's too many. That's too many pools. We want to get rid of all of our pools. So they put it up to a vote within the community, which pool are we going to get rid of. They go through the whole proper process, and they end up picking a pool and they end up getting rid of it. But once they end up getting rid of that pool, they decide, we really want to get rid of one more. We already have the votes. Let's just get rid of this pool over here. And so they get rid of that next pool because they wanted only 5 pools now. Now the problem is that there's a unit owner who lived next to the pool that got taken out second, and he loved going to that pool. That was his pool. He bought that unit because of the proximity to the pool or something, right? And he ends up deciding, hey, you guys didn't actually put this up to a vote. We only voted on getting rid of one pool to have 6 pools. Now we have 5, and you got rid of this pool. So he ends up suing the board because of it, and he ends up winning this case because they didn't actually follow their CC&Rs, and they didn't put it up to another vote. What they should have done was they should have put up this situation to another vote for them to vote on which pool they get rid of next. And this ended up coming out to a cost of the claim was totally $207,000. There was a $75,000 settlement with $132,000 for the cost of defense. So this last situation, and it kind of comes up a little soon, but this is Rocky Road HOA. And this is going to be a denied claim. And the reason why is because we're talking about D&O, not general liability. So this Rocky Road HOA, for example, they were sued for improper maintenance of a concrete walk. And the claimant's going to argue that he's tripping on the uneven sidewalk and he broke his hip, requiring surgery. So that is just screaming a general liability claim because that's a trip and fall claim, right? The association was supposed to maintain these sidewalks. He falls over from the sidewalk. Association's to blame. So he sues them. They try and file a D&O claim because of not maintaining the common area space. However, the D&O carrier is going to deny this claim because this is a bodily injury claim. So the general liability policy is probably going to be able to pick this up.
Yeah, Luke, maybe this is kind of good timing to kind of bring up the workers' comp because some board members are kind of curious about having workers' comp.
Yeah.
So when does an HOA actually would need a workers' comp if they don't have employees and they have only, vendors or like a gardener who come once in a while and maybe a handyman?
Yeah, it's a great question. So the workers' comp is always a little bit of a confusion when it comes to, especially on first-time board members, right? Your association doesn't have any employees. I understand that. However, your association's work comp policy is covering kind of mainly 2 main events. It can cover other things technically, but this is really where you mainly see the claim coming out. Number one, you have a situation where as a board member, you're essentially a voluntary employee. You're a voluntary board member, so you're going to be covered under this policy. Let's say a work comp claim arises from you doing an action as a board member, you get hurt or what have you. It's going to cover that work comp claim in that situation, but it really comes into play with those vendors, kind of like what you were talking about. The most common situation is, let's say you have this contractor or, let's say a landscaper, for example, and your landscaper is, they're properly insured for all you know, and they sign on with you, and then throughout a project, for whatever reason, maybe their policy went out of force without you realizing it, or or maybe they didn't properly fill out their forms, or whatever the situation is, they don't have proper work comp coverage. There has been cases, and there's been legal precedent where these the association is then considered the employer in that situation because they're contracting out. And so the association gets sued in that case. So the work comp policy is going to defend on that. And in reality, these work comp policies on non-payroll HOAs are, it's a few $100, which is, if a few $100 is no small payment for sure. However, it's a lot less than any potential claim that may arise in these situations. So it's always something that, I would say most HOA brokers, I know we certainly do, but we're always going to be recommending this.
Yeah. I think it's always interesting topic because obviously workers' comp is not required for an HOA to have, like obviously HOAs need general liability, property and D&O, but people look at workers' comp and go, like, do I really need to have like additional insurance? Like, why would I need it? So I think that's always something good to keep in mind because always having better protection, just kind of, the point of insurance is to kind of be prepared for the future or be prepared for all the mishaps. So I think that's important. And I guess another kind of insurance that board members always ask is earthquake insurance. And I know
Mhm.
it's pretty controversial. So, and I guess, Luke, from your viewpoint, how should the boards think about it realistically?
Yeah, that's a great question. I totally understand. Even though I said in the beginning of the presentation they're stabilizing, that's still an extra however much to your premium per year. I mean, that is not lost on me. What I would say is that as the board, it's always good to do a diligent search of the insurance industry every year. And when it comes to earthquake, definitely looking every year, every other year, even maybe, but actually having it in your minutes that you looked is better. And then choosing not to have it later on is better than not looking at all and a large earthquake comes through. And then now you have to explain to your community why you don't have an earthquake insurance. After the claim, it's going to be a lot harder to explain to the community, hey, we don't have earthquake insurance because it was expensive when now you have to rebuild. I understand, I totally understand if an association says, hey, we just can't afford this right now. However, it's a very big hole in coverage to where it's something that should definitely be looked at, especially here in California. I mean, when people think of California, when it comes to natural disasters, the first thing that comes to mind is earthquake. So, it's definitely something that is always recommended and always going to be offered and something that's always going to be talked about. Um, but I would definitely keep that in mind. If it's something where you're on the fence about purchasing it, I would say have your agent go out to market, have them look at all the earthquake carriers available, and have them give you a proposal and just see, hey, does this work for us? And if it does, I would always say having more coverages is better, so you should buy it. But if you end up deciding as a board, hey, this just isn't in the cards this year, then at least you did your due diligence and your financial duty as a board member to actually consider it.
Gotcha. And actually did receive a question from a board member actually yesterday about because she couldn't make it. She
Mhm.
asked, with the rising cost of insurance, what does that mean in terms of our premium today and maybe over the next year or two? How should we budget our insurance?
Yeah, no, it's a great question. I mean, it's the $1 million question, right? It's always hard to give predictions just because we don't have a crystal ball or anything. However, it's a very fair question. What I would say is first and foremost, management and the insurance agent should be communicating, right? And when budget season is coming up, the question, maybe you have your agent come onto a board meeting and just kind of talk about, how's our insurance renewal looking like? And, you might be far out from your renewal at that point, but the agent might at least have his finger on the pulse for any industry changes at that point. So having that constant contact with your insurance rep is always going to be paramount in that situation. However, I would say generally speaking, and this is ignoring claims, this is ignoring any extraordinary circumstances that may make it hard for your association to get coverage. I would say bottom line is I think a lot of insurance companies have started to realize that the old way of doing insurance was unsustainable. Believe it or not, California over the last 20, 30 years was considered one of the lowest insurance cost states within the country. And now, according to sources like Business Insider, I believe the number is closer to like 30, which, is we've definitely raised in that time. However, we're definitely far from like a Florida or a Texas, for example. Um, but I would say, generally speaking, one of the lessons that I think a lot of companies are learning right now is, they can't be underinsuring associations, which is a very long and in-depth conversation for another time, is making sure you have proper limits and you're properly covered. But the other thing too is making sure that they're keeping up with the rate of inflation, right? We've seen a lot of inflation over the past 5 years. And it's important for these insurance companies to make sure that they're keeping up with that inflation to make sure that if these claims pay out, they can pay them out correctly. So that's always going to be something to always keep in consideration is follow the inflation. There's most likely going to be inflationary increases, excluding any other external circumstance.
Yeah, thank you for providing such a the answer was such a great detail. And actually, if we don't have any other questions from our board members, I think we can conclude here. So, thank you to all the board members for joining us. We'll also send out a recording as well to all the board members. I really hope this was informative to all of you guys. And if you have any questions regarding to insurance or needing any help with insurance services, Luke is absolutely here to help. Do you have any last words to our board members, Luke, before we kind of end?
Yeah, absolutely. Well, first of all, thanks for taking the time to sit in this presentation on a Wednesday afternoon. I know that the team over at HOA Simplified loves providing you guys with great content and great opportunities to learn more about how to help serve your communities. What you're doing as a board member is a volunteer position, and I commend you for that. You're doing a lot of good for your community, and yeah, Simon's absolutely right. If you ever have questions, reach out to your broker or feel free to reach out to us. I know I can speak for us as an agency and say one of our big focuses is on education, and we love to do opportunities like this, and we love to just help people understand this challenging world of insurance. It's not a very it's not a topic that comes naturally necessarily. It's a very abstract topic, so we love to be able to try and help you decipher your policies and help you decipher your situation. So thank you
Awesome.
so much.
Awesome. Great. Thank you, everyone, again for joining us, and we hope to see you again for the next webinar. Thank you, Luke.
Thank you.
Bye.